Hi. Thanks, you two, for joining.
Great to be here.
Thank you for having us. It's great to be here.
We're not going to be announcing that Varo is buying Dave or Dave is buying Varo, are we?
No big surprises today, so sorry to disappoint.
Yeah, you guys described yourselves as frenemies to me backstage, so...
That's very true.
Yeah, good. Well, so, look, there are many ways of, many questions I have for you, but I might just start with one of the more general and more important ones, which is that we've got such a market right now, there's such a profusion of neobanks in the market right now. And we've got incumbent banks kind of slowly upgrading. So what do you see as the biggest opportunity in your space right now? And I'd like both of you to answer that, if you could. We can start with Jason.
Yeah, I'm happy to go. So first and foremost, I'm founder and CEO of Dave. Great to be here. Thank you, Ingrid. Started coming to this event back in 2008 when it was TechCrunch 40. It's been an awesome experience at TechCrunch. So when I think about the neobanking landscape, we have a significant advantage from a cost structure perspective, first and foremost. When you think about incumbents, they've admitted that it costs $300 a year just to break even on an average customer checking account at their bank. If you look at a company like Dave, we are completely digital first, we are branchless, and by virtue of that, using technology, we have about a $40 to $50 cost to serve, which means I have a significant advantage over the banks. I can offer great features at a fraction of the cost. That leads to a great customer experience. People tell that to their friends and family and drives a record low CAC. And we think that has a long-term advantage against the incumbents.
Which is customer acquisition cost.
Yeah,
Sorry,
exactly.
To just not have the jargon in there.
Yeah, that's our customer acquisition cost. We acquire a customer for about $15, and that's compared to several $100s and up at the incumbents. We acquired 700,000 new customers per quarter at that low cost to acquire, and we think that there's just such a huge room to run with such a large TAM.
Okay.
And I agree with everything that Jason just said about the unit economics and the economic advantages, but I'll also talk about it from a customer perspective. And by the way, Colin, Walsh, founder and CEO of Varo Bank. And why our company was even started in the first place is that there are so many people that are struggling to get ahead, to make ends meet, that especially in a world with higher inflation, higher interest rates, and they just need a better service. And the incumbents have largely turned their back on consumers who are living paycheck to paycheck, that are trying to get ahead, that are striving to live a better life. And the ability for companies like ours to create solutions that provide free banking services, instant payment rails. It gives them opportunities to build credit, to bridge to the next paycheck, to actually access credit for liquidity purposes, build savings, and to be able to package that into something that is so intuitive and so delightful for the consumer so that they can actually move ahead in their lives and they feel like they have a provider that really has their back and who they can trust. Like, that to me is what's so exciting about what we're doing, is because the incumbents, just because of the economics and the legacy technology and the siloed institutions, they just have not focused on this massive TAM of consumers that need a better solution. And it's these neobanks like ours that are delivering those solutions, and that translates in terms of super low CAC. By the way, we've got you beat on the $15, but I won't talk about that separately. We're now at sub $10 right now to acquire our customers. So anyhow, but
are you taking?
Anyhow, that's a whole other
is that
conversation.
At a loss to yourselves, though?
Not at all.
No, that's hitting at your margins.
No, not at all. These are super low cost customers. Most of our acquisition right now is coming through organic, so which costs us nothing. So anyhow, we'll keep going. But anyway, that's my take on why it's such a big opportunity.
You, but is that why it's so low?
That's right.
Because it's organic?
That's right.
Interesting. Okay. Did you finish? I don't want to interrupt.
I'm done for now.
Okay. So from taking away from that, it sounds like the opportunity is that it's because you guys have figured out, or because of the fact that you're not on your own rails, you're on other rails, you're able to take customer acquisition is lower cost, and you're able to give more customers better, or the same services that the banks do, but at a lower cost. Are you looking, is there an opportunity for different services as well, or is it really just about a like for like? Because, so here, I'm really curious about this, because at some point, it will presumably be very commoditized. If everyone is doing the exact same thing, it's going to get harder and harder to really distinguish one from another. And you guys will face a lot of churn, potentially it's just a race to the bottom over who's giving better rates on one service or another. So how do you guys move beyond that?
I'm happy to start. So look, neobanking has been around for 25, 30 years at this point, with companies out there touting that they have low fees, no overdraft fees, and offer the same sort of basic checking services that the incumbents do, but that never really gained a lot of traction. You needed a really new value prop that differentiated you in the market from the incumbents. There are over 10,000 banks in the US, and so for a company like Dave to acquire nearly 1 million customers per quarter, we're not actually going out to market and talking about no overdraft fees or no minimum balance using advertising. What differentiates Dave is that we are actually a credit-first neobank. And what we really solve for consumers, a massive pain point, was the ability to get access to credit, given most of the population's living paycheck to paycheck, and they don't have a high enough credit score to access the mainstream credit system. And so Dave really was the pioneer in cash flow-based underwriting to extend people no or low-cost overdraft to go buy gas or groceries. We knew that customers are actually relying on overdraft. I was actually that customer growing up, going through college, overdrafting my account, paying $34 of overdraft fees to go fill my gas tank. That was ridiculous. I thought, if Chase knows that I'm getting paid on Friday, I've been banking with them for 10 years, why charge me $34 when my paycheck's 3 days away? And so back when we started the company, a little unknown startup called Plaid was invented. And they were doing some innovative stuff in the space, but we were the first ones to recognize, could we take that cash flow data from an external account and use that to give somebody credit without the need to check their credit score? And that is our leading value prop. It's what drives the low CAC for us. And
it still does.
It still does.
Because you've moved into a lot of other services since then. But
we actually started out with this sort of no credit check product. Yeah. And we've expanded into checking accounts and savings accounts and finding the ability to find new work at the company. But you have to have a differentiated go-to-market. And for us, it's that no credit check overdraft product that you can get access instantly within joining.
Mm-hmm. What about you?
I would say,
how do you stand out?
So our differentiation, there's business model differentiation in terms of how I'd be different from Jason here, is we're a bank. So we're a fully regulated, we're the only fintech that actually got consumer fintech with a de novo OCC national bank.
Are you and still the only one?
Well, SoFi bought a bank and Lending Club bought a bank, but we actually went the de novo route. But we like to consider ourselves the sort of financial operating system for our customers' everyday life. So they can bank with us, they can move money with us, they can build their credit, they can access credit, they can build savings solutions all in a single app experience. But to go a little bit deeper on like how do we create differentiation, you could say, well, I could go bank at Wells Fargo and I could go, move money at B of A or wherever. But we've really taken to another level because we also consider ourselves a tech company. So let's take an example. So like in most banks, you look at your account statement and it's just a dumb ledger. It's just a bunch of transactions. But we've actually turned that into a smart ledger that is embedded into the app experience where we can enrich transactions. We can help people look at what their spending pattern is across categories and all of these. It's just one example, but it's just sort of how we continue to innovate inside of that experience for our customers that keeps drawing them back in. Our typical customer logs into our app 94 times a month. Okay, so I can count the number of times I've logged into my Wells Fargo account in the last year, like probably in both my finger, all my fingers. So it is a super engaging experience for the consumer because they are, to Jason's point, I mean, they care about credit, they care about cash cash flow. They want to know when their bills are going to get paid. They want to know when their deposits are going to hit. And being able to have solutions that are right there at their fingertips 24/7 is the real innovation. And so to your earlier point, the banks have kept up in the sense that they've invested more in mobile, but they really haven't built these super integrated experience. Their apps oftentimes reflect their org charts. So you see the credit card business, you see the mortgage, you see the wealth management, but it's not really integrated around what the problems and the jobs to be done that these customers are solving.
So on the subject of tech and what you're building into your apps to kind of bring in new services, I had a very interesting encounter with it's a neobank based out of Israel called 10. I don't know if you guys are familiar with it, but it's the Mobileye founder and CEO's one of his side hustles, and it's basically he's taken the concept of private banking, so very, very high touch customer service that you normally reserve for high net worth individuals, and he wants to create an AI that basically does that for the average customer. I'd love to hear what you guys think about that. Like, do you think that's possible? Is that the kind of thing you guys would like to do? And where is AI? So answer how you want. We can start with either of you, but I want to hear from both.
So AI is not like the be-all, end-all. I mean, I hate to say that here at TechCrunch. I'm going to but it is an important facet of how we live our lives today. And so when we think about, like, we have embedded AI and machine learning into every aspect of the customer life cycle, from account decisioning to fraud identification to dispute adjudication to credit underwriting to customer servicing. Like, we have machine learning models running in every aspect of the business. Now, do we want to create, what was the movie with Scarlett Johansson? Her, yeah, whatever. But like, her. I mean, like, I don't, once upon a time, maybe I thought that would be the bank of the future, but actually I think it's a little creepy and people aren't going to trust it. So I'd rather actually focus on building it in where it's adding value, even like the advanced personalization. Like we just launched a new lending product that became highly personalized, where every individual could see exactly where they stood and how much they were going to get eligible for and when they were going to become eligible, using all our machine learning tools and pulling data out of our feature store to be able to help personalize that experience for our customers. So I think it absolutely has to be foundational to how you build these sort of banks of the future, but it's not in and of itself the thing that in my mind is going to
So you don't think there should be a chat GPT for banking?
Just to expand on that, I think there's a time and a place for it, but I think where the customer-facing AI solutions really are advantageous, aside from what Colin just said. I totally agree with having AI integrated in every piece of the business, but from the customer-facing side, the chatbot experience really helps the lower-income consumer, the customer that's not going to get access to premium phone support. They're not going to get their domestic customer support. Even at Dave, we've integrated a lot of AI into our customer support. We call it actually Dave GPT that we developed internally, and about 80% of our customer inquiries at this point are being solved by this. And that's actually, from an NPS perspective, a better result for that person than being on an outsourced call. Because when it comes to having a low-cost service, a branchless platform, and focusing on low cost for the consumer, offshoring is one of the ways that we keep our costs low from a customer support perspective. And the more we can have a instant real-time chat experience with an AI agent, that helps the lower income consumer that we primarily serve at Dave. Now on the high end, with it's called 110. I was reading your article about it before this. 10.
Yeah.
I think that part of the banking system is actually not that broken, and that's why you see the JP Morgan still growing their business. They're doing well with mortgages, and the high touch experiences like private banking that I think is not as broken as it is for the lower income that are getting swallowed by all these huge bank fees.
Can I just respond to something Jason said? So I totally agree with the idea of having a chat service experience. So we use the LexBot. It's an Amazon product that we kind of co-develop with them. And it's great in the sense that it contains about 58% of our calls happen. But we actually just recently went to 24/7 service as well to be able to provide customers with a human alternative. Because even though it was great at handling certain types of inquiries, when there's edge cases, you actually do need, my view at least, and we wanted to put more investment into this just to continue to help customers handle those edge cases. And we've seen complaints come down and other things relate where they were just getting frustrated with the bot only type experience.
So you don't think that there is? I think it's very interesting to me. It's very ambitious. This idea that you can create a market for private banking essentially out of the mass market, but the private banking experience, providing all of those kinds of tools to help people manage their money and so on. Is that something that you're seeing any pull from your audience?
There's a definite need for financial education and financial literacy, and the more, to the extent that for a lower income consumer, and I think we probably serve similar demographics, there's probably overlaps in the demographics, to the extent that you can actually give them the tools and the advice, but it all has to be contextualized and also embedded into the actual solution itself, so that customers are getting what they need when they need it. We're not advising customers on, how to, make $1 million trades or anything like that. I mean, it's really pretty basic, but very important to the person that's living paycheck to paycheck.
Okay, I'm switching gears. You guys are you're taking two slightly different approaches when it comes to how you're growing your businesses. You've got Dave is publicly traded. You went public via SPAC. That's right. You are still privately held. What are the advantages of one over the other that you think you've gotten from taking those two different routes?
You can go first.
You want me to start?
I mean, SPACs have had a very, very, very bad rap. So do you feel fortunate to have taken that route, or do you feel like you've recovered from having taken that route?
I think we're on the path to recovery. I think the challenge of SPACs, I think it's actually a very viable way of going public. Unlike an IPO where the valuation discovery does not happen until the very end, there's a lot to like about a SPAC where you agree on a price, you agree on the amount of capital you're going to raise primarily at the onset before you take the time to go down that route. And while Dave could have done a traditional IPO, we felt a lot more comfort in the fact that we had a marquee lead investor with Tiger Global leading our PIPE investment. We trusted the SPAC sponsor who was already our debt facility partner, and at the time we thought that was the right way because we knew it was going to be very non-dilutive capital and a guaranteed certain sum of money for the business. Now, if you told me that the markets were going to fall apart for any company and losing money 6 months after going public, we probably never would have gone public at that time. But would if you just opted to raise money privately in that case? I mean, did you have that option? Of course.
Yeah, you did.
Of course. Okay. I mean, the company was growing tremendously. We're still a 30% plus top line grower. The business is doing fantastic. We've had 3 successful quarters of profitability through Q2 with earnings coming up here shortly. And we're a $600 million market cap business. I think we're tremendously undervalued, but we also have a very clean cap table as a result of being public. We have no preferred equity compared to a lot of our private peers that have raised arguably too much money. They're sitting behind very fat cap stacks that are going to be hard to get out from underneath. And Dave is very clean. We have no debt. We are profitable. We control our own destiny. And the valuation has increased 1,000% in the last 9 months. And so we think there's just a long way for us to go. And it's been a tremendous learning experience too to be a public company CEO.
So you're glad to have taken that route and stayed that route.
Yeah, I mean, we could have gone back and gone private at any point as well, and we decided to just keep our heads down, focus on the business, build our investor relations function, get analyst coverage. It's completely different than being a private company. It's almost impossible to compare the two, but I'm glad we went through the pain because having this public market currency, I think, is ultimately very valuable in the long run. And you can't imagine how many calls we get from the private companies that are looking to find an exit through something like Dave that is already public and doesn't have a complicated capital structure.
Okay, and we'll get on to the complicated ones in a minute, but first to hear from you. Advantages having remained privately held.
Let's just say we dodged that bullet.
Just-
Sorry.
Yeah.
So
the
believe me,
few.
they were all knocking on our door saying, "Oh, you should SPAC. You should
I mean,
SPAC."
do you? Yeah,
Well,
I bet you did. But do you kind of? Are you happy to be private
oh
now,
God, yeah.
or do you sort of wish you?
God, yeah. No, yeah. We weren't ready to be public, and we
Are
were.
you ready now?
And we're getting ready, but we're a bank too, so we had the advantages of having our cap table is all common. It's we have no debt. We've got lots of liquidity because we've got lots of customer deposits. So like there was really no reason for us to do it other than maybe there had been capital. And to your point, you do get more of the PR advantages and publicity. But I'm so glad we didn't do that. And so I mean, and we have great investors. I mean, we've got some of the best blue chip investors on our cap
How
table.
much have you raised now?
Over $1 billion.
You've raised over $1
Yeah,
billion. Would you
yeah.
consider that a complicated cap table?
Well, it's all common equity that he's raised, and so it
Right.
sounds not uber complicated.
Okay.
Yeah,
okay.
but it's given us the ability to continue to invest in our stack, in our product.
And what is your valuation
So
now?
that's not something we've disclosed publicly. Sorry.
Ever?
So, well, we haven't raised in a long time either. So So
What would have been your last valuation? then?
it's not something we disclose. Sorry.
Okay.
No.
But we could disclose it here, right?
In 2021,
Who wants to hear it?
we were at 2.5 billion, but that was also in the go-go
Which year
days.
was
So
that?
that was 2021. That was in the go-go
Oh yeah.
days. So yeah.
But that was
and we've
that
come
was
a long,
salad days.
and we've come a long way since
Yeah.
then.
Oh,
so,
in a good way?
In a good way. Yeah.
Okay.
Yeah. Not necessarily from a valuation perspective, but from a business progress
Okay,
perspective. Yeah.
okay,
So,
okay.
no.
So on the subject of these complicated companies, there's obviously a lot of space for consolidation, let's call it. There's also been some massive crashes in the market. Maybe we can just focus on one of them, Synapse. How did that impact your businesses? I know that Varo, was it Varo that used to be a customer of theirs, or was it Dave?
No, we
You
weren't.
guys
We used to
wouldn't.
be, yes.
Yeah, pre-problems.
That's right.
Yes. But in the kind of spirit of contagion and of things impacting the wider ecosystem, what was the impact of something like Synapse or any problems in the market on your companies?
There's no direct impact to our business other than the contagion of, do you think that your business is at risk?
Exactly.
It creates a lot of questions in the market about what's going on with the industry, but a lot of sort of fake news out there that a lot leading to like the FDIC insurance situation where what happens if a fintech company goes bankrupt? Is your money all of a sudden gone? And that is completely false. That if a fintech goes bankrupt, that they can't actually use their deposits to fund their business. Certainly not the ones that are non-banks like Dave. And we keep all of our deposits at a third-party
I think
sponsor
that's
bank.
a Silicon Valley Bank after effect, actually.
Yes, yeah, that's right.
People assume money is just going to get gulped down into a cesspool, but
Yeah, that's right. And so people were generally worried there, but we've seen no slowdown in customer acquisition as a result of that, and it really was just people trying to sort through the news.
Right, okay. What about
And
you,
for us, it
Colin?
was actually a net positive because we did the hard work to become a regulated institution and that we could say we are a legitimate bank. We're a real bank. Your money's safe. Most of our deposits are sitting at the Federal Reserve. So for us, it was actually kind of a positive, but there was a little bit of that, kind of pall that got cast over all fintech as a result of that. But there has been, and we were talking about this earlier, a little bit of a thinning of the herd. Like there were many, many neobank players a few years ago, and there are a lot fewer now. And so the ones that have the strongest business models, the strongest unit economics, ability to acquire customers at a low cost, I mean, they're the ones that are surviving. But the market has changed, and I think the Synapse example was probably the most high-profile blow-up, and unfortunately, the aftermath was terrible for consumers. But I think the market has changed dramatically in the last 2 years.
Do you think either of you would play the part of consolidator in this space? I mean, we were talking backstage, and I would name names, but there are several neobanks that are essentially looking for buyers right now. So would you guys want to buy neobanks, and what would be the benefit of doing that versus just sitting and waiting for them to do what they need to do so that you can scoop up their customers?
It would depend. I mean, for us, we look at things that are either going to increase lifetime value as a cross-attached new feature we can offer to our users, or it has to be something that there's a benefit from just consolidation, having huge economies of scale. Right now, I'd say the companies that have been looking for buyers have that really complicated capital structure. They're still burning a lot of money. They've raised hundreds of millions of dollars. And from Dave's perspective, we're finally getting our footing on profitability. There's no way we could swing the other way through an acquisition. So it would have to be something we really had a lot of conviction that we could acquire and get profitable really quickly, if not something that's already profitable and thriving. So nothing that we've taken seriously that that's come on the market.
Okay.
Yeah, I would very much agree with Jason that for us the screens it has to be accretive from an earnings perspective, not we can't pick up somebody else's burn at this point. And it also either has to bring in some form of like captive distribution where they have like a distribution network that's going to be immediately accretive to help us drive more scale and market share, or some sort of a product that is on our roadmap that becomes a buy versus a build decision. So there definitely are discrete criteria that we look at when we consider any sort of consolidation play.
I mean, I know there's been a little bit of this in the U.S. market, and you have experience, of course, in the U.K. There was quite a bit of it there, but the incumbent banks have been pretty strong in picking up these smaller neobanks. Do you think that's a trend we may see here play out? It hasn't happened much.
You've seen a little bit here and there, like Simple and BBVA, and that. But
that was a bit of a disaster in
But
the end,
many of the
wasn't it?
incumbents have tried to do their own. I mean, think about Finn or what was the Wells Fargo Greenlight or something.
Yes,
they all kind of fizzled out. So incumbents have a lot of challenges from a tech perspective, just in terms of their tech stacks as well as their business models and their cost structures. So I think any neobank that gets acquired by a incumbent, I would say good luck.
Right.
So.
Okay.
Agreed.
I have a lot of questions and not much time. Let me ask you one very quick thing, because I'm quite curious about it. Crypto. Now, in the UK, where I live, we have seen a massive swing into crypto services from neobanks and vice versa. Things start as crypto account apps. What of a role do you see for that from where you're sitting? Is that anything you want to touch or not so much?
Want to talk about your new hire?
Yeah, well, I just hired the guy who was running a crypto exchange.
Exactly.
So Gavin just joined my team. He was the CEO of Backed. But I would say that given the audience of consumers we serve, what matters most to me is expanding financial inclusion, helping people get ahead, creating financial opportunity. And I would just want to make sure that any financial instruments that we're offering to our customers, that they're well understood, and that they can play a purpose in the customer's life.
So what does that translate to?
A use case could be like international remittance, perhaps. Like I know David Marcus is working on a new company to sort of help do international bank-to-bank transfers. That's an interesting use case from my perspective. But like for
an interesting blockchain use case.
Yeah, exactly. Versus just having crypto as like a commodity asset class. Yes. I'm not sure. It's been very volatile.
Yeah. What about you, Jason?
I would agree. I think from a blockchain perspective, a lot to like about that technology. I think just being able to establish a trusted pattern of quick money remittance and money identity is really important. But I agree with Colin. For our customer segment, which is largely $25,000 to $75,000 of income, the best thing they can do with their money is to stop paying fees on their financial products. Avoid paying interest on your credit card. Avoid paying overdraft fees, minimum balance fees. Our average customer is spending about $400 a year in bank fees prior to coming to Dave, and so that on a total return of their net worth is better than being in Bitcoin.
Okay, last question. Now, we very briefly talked about the market penetration. You said we've got, let's see, let me get the numbers.
About 180 million Americans.
180 million overall in banking, 30 to 40 million in neobanks.
By the way, that's just 180 million are just people living paycheck to paycheck. Right. There's 250 million total, but it's amazing how many people are just living paycheck to paycheck.
Do you feel that I know obviously you've got a large addressable market, but have you ever wondered if maybe one other direction for growth would be going outside of the U.S. into other markets, or do you think that the growth for your future is in the U.S.?
We haven't made any commitments to going international, but our investments in our cash flow-based underwriting that we call Cash AI is something quite interesting for different markets, given we're using truly cash flow data alone to offer people credit. We're not using the credit bureaus, which is very fragmented across the globe. And so there is something quite unique there, but we're still have so much penetration to go on the TAM in the US. And the US is a lot more credit hungry than potentially other places in the world. And so we like our sort of singular focus right now.
Okay. Colin.
I would say huge TAM opportunity in the U.S., lots of room to penetrate, but most of my career has been global in nature, and most of my management team, so I would never say never.
So you
but
have
not,
a maybe
but not,
a view
but not
to
right away, not in the near term.
Okay.
No.
Thank you very much, you two.
Yeah, thank you,
Thanks so
Ingrid.
much.
Right.
Yeah. Thanks,
Thank
everybody.
you.